Today, we will talk about how to pay yourself from your LLC. What is an LLC? An LLC is a hybrid business structure that combines some of the most attractive features of corporations and sole proprietorships. Like corporations, all types of LLCs provide limited protection against personal liability. In general, business profits and losses are reported on your personal income tax return rather than a business tax return, and no annual meetings are required. Here are 6 main ways you can receive payments from your LLC. 1. How to pay yourself LLC income through an owner's draw. As pass-through entities, multi-member LLCs do not pay corporate taxes. Instead, the tax is the personal liability of the business owner. The same is true for a sole proprietor, single-member LLC owner. When deciding how to pay yourself in an LLC, consider taking distributions of business profits each year as personal assets. Each member owns a percentage of the LLC. Year-end distributions of an LLC's profits are made based on that percentage from the business account. So if the LLC had $100,000 in profit and you and the other member each own 50%, you can each receive $50,000. This would appear on your personal tax return. Owner's draws come from a business account set up for an owner when the company is formed. This account holds their initial contribution to the small business and amasses their share of the LLC's profits. The business entity can set the frequency of payments in its operating agreement. If you expect your percentage of the year-end LLC profits to be $12,000, you could set up a draw to receive $1,000 each month as personal assets from the business bank account. The total of all the draws throughout the year is deducted from the total year-end profit. So if your draw for the year totaled $12,000, but your share of the profit ends up being $15,000, then you would receive $3,000 at the end of the year. To pay yourself LLC income through an owner's draw, write a check from the LLC to the business owner's personal account. Record the withdrawal as an owner's draw, along with the appropriate debit in the owner's business account. This periodic payment eliminates the need for payroll taxes and forms. The LLC need not withhold taxes on distribution payments, meaning there are no W-2 or W-4 employee withholding forms to deal with. Instead, you will report your share of the business income on your personal tax return and pay income taxes and self-employment taxes on it. 2. How to handle income tax on LLC pay. An owner's draw taken from a multi-member LLC or a single-member LLC does not affect the income taxes you pay on your total share of the profits. Owners in an LLC owe income tax on the amount their capital account amasses from the year's profits, regardless of how much they draw that year. This means you owe income tax on your share of the LLC's profit, known as your distributive share, whether you draw it or not. So if you leave some money in the business, perhaps to cover expansion costs, you are still liable for personal income tax on that amount. Unlike with payroll in a C Corp, an owner's draw is also not considered a deductible business expense for an LLC by the IRS, meaning it cannot be claimed against corporate tax. 3. Pay yourself as a W-2 employee. For many LLC owners, the most advantageous way to receive payment is to treat yourself as an employee. In this arrangement, you and other owners who actively work in the business are employees/owners, and you receive paychecks just as you would as an employee of someone else's business. As long as your business brings in revenue consistent enough to cover your salary or wages, this can be a way to set yourself up with predictable pay for your household. According to the IRS, you have to pay yourself reasonable compensation. The IRS doesn't explicitly set an amount. It just needs to be a typical amount someone doing your work gets paid. If you pay yourself this way, you can elect to be treated as an S corporation for tax purposes. The advantage is that you only pay FICA, Medicare, and Social Security taxes, colloquially called self-employment tax, on the salary or wages you pay yourself, not on all business profits. That's a tax savings of around 15% on some of your income. 4. Earn profit distributions. Any LLC member, UCA, shareholder, can be paid through profit distributions or owner's draws. This means passing business profits on to owners. The process can be more complex if you're part of a multi-member LLC, But for a single-member LLC, this pretty much looks similar to the way you'd pay yourself as a freelancer. Money comes in, and you distribute it to your personal bank account. For multi-member LLCs, your operating agreement lays out how profits will be allocated and at what frequency. The drawback of using this as your main payment method is that you'll pay self-employment taxes on all the money that comes into your business, instead of on only a designated salary. If your business is your main source of income, you might instead pay yourself a salary as an employee and take an owner's draw on additional profits. 5. Pay yourself as a 1099 independent contractor. You can technically pay yourself as an independent contractor instead of an employee of the business, but this isn't always advantageous for most small businesses. Paying yourself as a contractor means you forego taking payroll taxes out of your paycheck, and your personal account receives your full pay as with any other contractor. You typically don't save money this way though. Instead of paying payroll taxes from your paycheck, you pay that same amount as self-employment tax when you pay quarterly taxes as an independent contractor. This approach could also be complex because you have to claim taxes as both the LLC owner and for your work as a contractor, as a sole proprietor, or as the owner of a separate LLC. It might make sense if you're a shareholder in an LLC that you don't actively work for and want to provide occasional services, but it isn't a common approach if you own and operate your LLC. 6. Keep the money in the business. The last option is to not give yourself a paycheck at all. You might do this if you want to put earnings back into the business instead of your pocket, or if you want to build savings within the business. You still have to pay income taxes on any profit the business generates, even if you don't take a paycheck or distribution. Tax authorities treat LLCs by default as pass-through entities, so those profits are included in your income for tax purposes. The business doesn't pay any separate tax on them. If you elected S-Corp tax treatment, be careful about using this option. Not paying yourself could pass the reasonable compensation test if the business isn't generating much revenue. But you typically can't leave money in the business to avoid paying self-employment taxes that could cost you in fees and back taxes down the line. How to distribute your paychecks as an LLC owner. Once you've set up a separate business entity, you can set up a business bank account as well. This isn't required, but it's a big help to keep your accounting in order and protect your personal finances in case of liabilities against the business. The money you earn for sales or services should go into the business account first. Use that to cover business expenses and make payments into a personal account you use for personal and household expenses. You can take money out of your business account in any form you want: aid, cash, paper or electronic checks, ACH payments, PayPal, or Venmo. However you do it, you're responsible for applicable income and self-employment taxes on your business income. A payroll service can significantly simplify this process. For example, you can sign up for a service such as Gusto or Wave, set yourself up as an employee or contractor, and automatically receive payments to your personal bank account via ACH. Gusto even files W-4s, W-2s, W-9s, and 1099s for you and pays payroll taxes automatically. Wave does this in some states. Paying yourself from an LLC can seem complicated, but it doesn't have to be. If the business is regularly generating revenue and you actively work in the business, you'll most likely pay yourself a salary or wages as an employee. But you have other options to explore if your circumstances are different. If the business isn't earning a profit or you're a shareholder who doesn't actively work in the company. Payroll services can take care of a lot of the heavy lifting for you once you decide how you'll be paid. Free payroll software is also an option if budget is a concern. No matter your circumstances, consult an accountant or tax attorney to help you choose the right approach for your business. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.